Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. In today's episode,
tourism-dependent economies are on their knees. Countries with high debt levels are in terrible trouble. And the virus is now moving where health systems are weaker.
IMF Managing Director Kristalina Georgieva says many developing markets are not seeing the economic upswing that developed markets are seeing, and in fact could see their growth forecasts downgraded. Debt levels are so high, she says, they are suffocating. A collapse in tourism and trade and falling commodity prices have dealt a severe blow to emerging markets this year, many of which were fundamentally weak to begin with and ill-prepared to cope with a health crisis. But demand for stocks and bonds in the region has improved in recent months, and the US Federal Reserve's plan to keep interest rates lower for longer could provide further relief. I'm Rebecca Byrne, and today I'm joined by Trieu Pham, ING's emerging markets sovereign debt strategist, to find out what the future holds for some of the most vulnerable economies in the world. Trieu, it's been a bit of a wild ride for emerging markets this year, hasn't it? Back in March, it looked really bleak. Investors were yanking money out left, right and centre. But since then, there has been a turnaround. Are things starting to look a little bit more stable now?
Indeed, it was a mad time in March, and the Institute of International Finance reported 89 billion of outflows, and there was a big scramble for dollar liquidity. So record outflows in nominal terms, but we also have to appreciate that EM as an asset class has seen rapid growth over the recent years. Since March, we've actually seen inflows coming gradually back. And to a large extent, that has been helped by looser monetary policy in developed markets. And we also have seen, well, as a healthy sign, plenty of issuance, bond issuance in emerging markets. Other good signs, we have seen multilateral institutions stepping in, especially the IMF, that has started emergency programs for emerging market sovereigns. And that has been also quite supportive. And then for the poorest emerging markets, the G20 has also started a debt service suspension initiative. And that, for now at least, has postponed the risk of debt vulnerabilities in 2020. On the fundamental side, we also have seen improving signs here recently, especially in China, where the domestic demand picture has improved quite a bit. And there's also good signs across the emerging market based on the fact that on the external front, actually, a lot of countries are booking in current account surpluses this year, mainly driven by import contractions. But nonetheless, I mean, it helps on the external financing side. So all in all, it looks like the worst on the capital flows front seems to be over, even though there are certainly still a lot of vulnerabilities and challenges to emerging market economies going forward.
Well, we heard from the Federal Reserve this week, Jay Powell reiterating that interest rates will stay low for years, essentially. Now, in more normal times, you might have expected that a backdrop of lower US rates would be quite helpful for emerging markets, because obviously people are looking for places where they can get higher returns. But is it helping this time? Is it making emerging markets more attractive?
Absolutely. With the normalization that we have seen in markets since April, the search for yield pickup has actually returned. And I think that's also very well reflected if you look at the amount of negative yielding bonds outstanding, which has now risen again and is back to almost 16 trillion US dollar. Certainly the record outflows in March and the ongoing pandemic means that there's still a lot of caution out there. So the recovery has been more gradual, but inflows have been coming back into the asset class. And we are not only seeing inflows into emerging markets funds, but it's also a lot of crossover demands. So from investors that don't see emerging markets as their home, but have been coming into the asset class because of the yield pickup.
But some countries have been using unconventional policy for the first time, really, to tackle this crisis. But that can be risky, right? Are you concerned that these new policy measures could damage or undermine credibility in some countries?
That's indeed something quite new in emerging markets. Developed market central banks have set the tone, obviously, over the last decade. But EM central banks, have recently started to copy them to some extent or created their own version of unconventional monetary easing. It's not entirely the same as in developed markets. In most emerging market countries, the policy rates remain well above 0%. So it's not like the same case as for the ECB and Fed, where rates are already at or below 0%. Most emerging market central banks, when they took those measures, they argued that those were essential to keep markets functioning. And also, when we look at government debt purchases by central banks in terms of percentage of GDP, we're talking about relatively small sizes for most countries. So, for example, in the case of South Africa, it's only around 1% of GDP. There have been some concerns arising in countries that have gone a step further. I think Indonesia is a very good example here, given that they started debt monetization, so the central bank directly financing the government. The positive first is that Indonesia in recent years has built a very strong reputation of prudent fiscal policies. Especially debt to GDP is relatively low at only around 30% before the pandemic. And also the Bank Indonesia has been considered as quite prudent as well. But this year they participated in a program called burden sharing, which is the debt monetization I mentioned, which has been generally frowned upon by investors in ordinary times. I think this time investors do see that special times also borrowing special measures, but there are big question marks on whether this will be continued into the next year, for example. And well, at least in 2020, it's unlikely to affect the inflation outlook too much. And also supportively, the dollar has been on a weakish footing. But if that were to change in the future, then obviously that is a risk for those unconventional measures.
True, many emerging market countries like Brazil, India, South Africa have really struggled to contain the virus. And unfortunately, they're also the countries where the fiscal support has been smaller, relatively speaking. Is there anything more they can do, or are they going to need some outside help?
Yeah, fundamentally, the pandemic is certainly an uphill battle for emerging markets. And in comparison to most developed markets, the monetary and fiscal space is much more limited. The IMF has urged countries to use fiscal space where possible to protect the most vulnerable, but it's not really that easy. Not only, as mentioned, is the fiscal space quite limited for most countries, but it's also that most of those countries have quite large informal sectors as well. So if we look at what other measures they could take beyond the direct fiscal measures, I think some have also implemented credit guarantees, for example, provided some temporary tax relief at least. So in measures that have more indirect impacts. But positively, I think multilateral institutions such as the IMF have also provided countries with fiscal support. It's interesting that you mentioned Brazil, India, and South Africa, as these countries have seen either subdued growth in the past already, even before the pandemic. Like in Brazil and South Africa, growth has been below or around 1%. And India has seen growth slowing as well in recent years. And also the fiscal backdrop has been on a weaker footing, meaning that the COVID-19 crisis certainly exacerbated the already weak outlooks there. So it's a tough environment, and all countries have reacted a little bit in a different measure here. South Africa, for example, taken very severe lockdown measures, while Brazil has been, let's say, tackling it with less measures. And we will have to see which works actually best.
What do you think are the biggest risks for developing economies going forward? Is it the drop in tourism, weaker trade, lower oil prices? It just seems like there are so many things to be worried about.
Despite the broad recovery in emerging markets risk assets, there are still plenty of vulnerabilities when we look ahead. And the drop in tourism, weaker trade, and lower oil prices are all factors that are relevant. But the question mark is really how long this pandemic will continue and whether 2020 will remain a one-off or not. Another big question mark is how and when a vaccine will be available. and how they will be distributed in these countries as well. And it looks like that could be quite slower than in developed markets. So the pandemic will probably play a role even going into 2021. And if I think about what could be the biggest risk factors for emerging markets economies, I am also looking at the fiscal space. And certainly countries are using fiscal stimulus this year to offset negative growth impacts from the pandemic. But this leaves a large fiscal burden in the years ahead. So far, we haven't seen actually many defaults just yet, but the pandemic will leave a burden that will be challenging to unwind when it comes to fiscal positions.
True, people often think about emerging markets as one homogenous block, but it's incredibly diverse, isn't it? There's lots of country-specific issues. Which ones are doing relatively better and relatively worse?
Yeah, there are some reasons why emerging markets is often talked about as a block. First, a lot of benchmarks obviously are out there, and if there are inflows or outflows coming into the asset class, it will affect most of them, like we have seen in the March outflows. If we, however, look across the space, obviously the differences across regions and countries is actually quite huge. We have countries with very strong fundamentals, and then we have also frontier markets, especially in sub-Saharan Africa and then Latin America and some parts of Asia as well that are facing larger challenges. One factor that is becoming quite important for investors, especially, has been governance. Countries that have shown a strong policy track record in recent years when it comes to governance, to prudent fiscal and monetary policy, seem to have been doing better in attracting investments.
True, there have been record levels of bond issuance this year, but some countries have still seen borrowing costs go up. Some have been denied access to the markets. We've got countries like Argentina, Lebanon, Ecuador, which have already defaulted. Are you concerned that there could be more defaults?
Certainly, the pandemic has created distress in a lot of emerging market space. And we've seen especially that the amount of sovereign bonds with yields above 10% has risen substantially. But with the normalization, actually, we have seen also a recovery in that and a substantial drop. Argentina, Lebanon, and Ecuador, the ones that you have mentioned, they had been facing issues already in the past. But I think going forward, that distress could remain a big topic because we are also facing a big wall of maturities, especially after 2024 in frontier markets. In the meantime, when it comes to bond issuance, this has been a record year, 2020, because of the higher fiscal needs in emerging markets. But what I'm also seeing is there's a risk that we are seeing a growing divergence here, with the stronger sovereigns, the stronger emerging markets being able to tap the market quite easily. But then when it comes to frontier markets, they seem to be left out a bit.
All right, Trieu Pham, ING's Emerging Markets Sovereign Debt Strategist. Thanks very much.
Thanks a lot, Rebecca.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, and nor is it investment, legal, or tax advice, or an offer or solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.